inflation lags. You change the money supply, and there's usually a 12 to 24 month lag before the inflation starts reacting to whatever has been going on with the money supply. So I think that right now we've got 2.8% as a headline CPI number. That probably will come down to 2% or a little below 2% this year. We know what's going to happen because of what happened 12 months ago and 24 months ago in the money supply.
This is Little by Little with Andy Schechtman.
Welcome back, everybody, to another episode of Little by Little. I am thrilled to have someone that is so highly esteemed as Steve Hanke with me today. Now, I normally don't do this, but I feel like I have to do this because I don't know that I've ever seen someone with such a really fantastic resume. So just to set the table for people who don't know you, I'm going to read just a little bit about your background because it really blew me away, actually, what you've accomplished in your lifetime. It's rather amazing and certainly something that I think you should be proud of. So just a simple Google search says that you are currently a professor of applied economics and founder and co-director of the Institute for Applied Economics, Global Health, and the Study of Business Enterprise at the Johns Hopkins University. You are a senior fellow at the Cato Institute in Washington, D.C., a senior fellow at the Independent Institute in Oakland, California, a senior advisor at the Renmin University of China's International Monetary Research Institute in Beijing, and a special counselor to the Center for Financial Stability in New York, also a contributing editor at Central Banking in London and a contributor at National Review. In addition, you are a member of the Charter Council of the Society for Economic Measurement and the Euromoney Country Risk Experts Panel. That's an interesting one. In the past, you've taught economics at the Colorado School of Mines and the University of California, Berkeley. You've served as a member of the Governor's Council of Economic Advisors in Maryland from 1976 to 77, a senior economist on President Reagan's Council of Economic Advisors from 81 to 82, a senior advisor to the Joint Economic Committee of the U.S. Congress from 84 to 88, served as a state counselor to both the Republic of Lithuania from 94 to 6 and the Republic of Montenegro from 99 to 03. You were also an advisor to the President of Bulgaria from 97 to 02, Venezuela from 95 to 96, Indonesia in 98. My goodness gracious. You played an important role in establishing new currency regimes in Argentina, Estonia, Bulgaria, Bosnia-Herzegovina, Ecuador, Lithuania, and Montenegro. Also had senior appointments in the governments of many other countries, including Albania, Kazakhstan, United Arab Emirates, and Yugoslavia. Do you have any time to do anything for yourself is really the first question. See, that's a resume that I don't know I've ever seen one that's quite that impressive. Congratulations. That's for darn sure. And thank you for being here.
Well, it's great to be with you, Andy. Yeah, I've got plenty of time to be with Mrs. Hanke, and we do our thing.
Yeah, well, I would venture to say someone with your type of work acumen has probably read every one of those books over your shoulders. But it's an honor to have you here, sir. Certainly someone of your pedigree, and I'm looking forward to learning from you today. So we'll jump right into it, and in respect of your time, let's just get right to it.
And Andy, one thing, let me add one footnote to the resume thing, because there is the academic thing, which you more or less covered, and the shall we say, political economy and advising ministers and heads of state, that sort of thing. But there is another aspect, and that is my business life. And one thing I'm quite proud of is that in 1995, I was president of Toronto Trust Argentina in Buenos Aires, and it was the world's best performing fund. So if we have financial types on, that sort of thing perks them up a little bit.
Yeah, it does, because I think some people look at themselves as being academic, and you've certainly bridged the gap between academics, politics, finance, I think you have a very well-rounded career, something you should be exceedingly proud of. I've interviewed a lot of people, talked to a lot of people. I don't know that I've ever seen a resume that holds a candle to yours. So, like I said, it really is an honor to be here, and looking forward to learning from you. So let's just make this first one kind of a softball, nice and easy. What's the one financial trend that you think most people are completely missing right now here in the United States?
Well, most people in the United States, as well as the UK and Europe in general, they don't pay attention to the money supply and movements in the money supply, and that's a real fundamental flaw. Wall Street, by the way, pays no attention to it either. Certainly, the Fed doesn't pay any attention to it. The chairman of the Fed, Paul, is explicitly said in testimony that the Fed doesn't pay much attention to the money supply because he claims there's no connection between the changes in the money supply and economic activity. Well, this is just nonsense. The quantity theory of money is the only reliable model for what we call national income determination. Now, what's that mean? That means that changes in the money supply will eventually lead to changes in asset prices, changes in real economic activity, and changes in inflation. And those last two components, Andy, the real economy, the percentage changes in the real economy and percentage changes in inflation, those two things together are nominal GDP, because nominal GDP is made up of what? It's made up of inflation plus whatever is going on in the real economy. So if you want to know where nominal GDP is going, you've got to go to the quantity theory of money, which has been around, by the way, since really the 16th century. It's only lost its following in about the last 30 years when post-Keynesian economics has become in vogue. And if you look at those post-Keynesian macroeconomic models, they don't even include a metric for some measure of aggregate money. So this is a fundamental theoretical flaw and a practical flaw, because, for example, we when COVID started in early 2020, what happened? The Fed started goosing the money supply. It went up to actually a year-over-year peak, and it's never reached this high before, of 17%. And there's a transmission mechanism. Once the money supply changes, things don't change overnight. There's a lag between the change in the money supply and change in asset prices first. And what happened? We had the stock market boomed. They shut the economy down. Everybody got very bearish. Well, no, that was the wrong thing, because the money supply was being goosed. So land prices went up, real estate went up, the stock market went up, all asset prices boomed. And then what happened? Then the real economy started kicking in and doing much better than people thought. And then, sure enough, inflation raised its ugly head, and we went up to, a very high rate of inflation in this era. But
Well, a couple thoughts come to mind. I've been in the metals industry maybe longer than just about anyone. Been doing this for 35 years, at least in terms of the competition in this industry. And I remember Richard Russell was somewhat of a mentor of mine. I'm sure you remember reading Richard over your time. And he would always talk about M3, which I think it was Bernanke got rid of M3, saying it was an archaic measurement of the money supply. No one uses it anymore, but it was always the broadest measure, making it a little harder for us average people to track the money supply and to see how much they're adding. And you're right, there is no question, but all of this money has created distortions in asset prices. I wonder what asset prices really are if we were to factor in the massive amount of money creation, which has led to inflation and, to your point, great distortions in asset prices, misallocations of resource and capital, those kinds of things, on top of making it harder to discern just how much money was put in, and questionable measurements of the CPI, the measurement and gauge of inflation. It's become much harder. Would you agree to follow those trends and to really know what price discovery is? Do you think it's a little harder than it was in the past?
Well, on average, yes. But if you know what you're doing, the answer is no. And now you mentioned Russell, and he was following M3, which was the broadest measure that the Fed was putting out at that before the Fed dropped it. Now, why did the Fed drop it? Because they dropped the whole idea of even following the money supply. So they dropped the key measure because the broadest measures of money are the best measures for national income determination. And the reason for that, Andy, is that that's the amount of money that the non-bank public holds. And that's where the firepower is. It's the non-bank public. How much money do they have in their wallets or their bank accounts that they can fire away with? So that's what you want to measure broadly. So if we look at today, you mentioned that I was a special counselor at the Center for Financial Stability in New York, and that is the only place you really can get accurate measurements of the money supply. And the measure, they actually have an M4 measure. So if you go to the Center for Financial Stability, Professor William A. Barnett, by the way, is the greatest expert on measuring money, and he's associated with Center for Financial Stability, as I am. He's actually a professor of economics, a distinguished professor at the University of Kansas. But he's the guy, William A. Barnett. You can go.
I will check that out. Now, you called me a cynic or skeptical, but my guess is they are paying attention to M3. They just don't want us to pay attention.
Well,
to M3.
I don't think that's probably right, because none of their models include any money. They don't include even M2. So I doubt if they pay any attention to it. Now, you mentioned asset prices and the distortions that you get with asset prices. Let's talk about the big distortion that's recently occurred in the distribution of income in the United States and asset prices. And that is, we goosed the money supply starting with the COVID lockdown in February of 2020. Asset prices boomed, as I indicated. And at that time, when COVID started in February of 2020, billionaires in the United States held aggregate amount of wealth equal to 14.1% of GDP. What is that now? It's 21.1%. So what the Fed has done, their policy is not neutral with regard to income distribution. It distorts it a lot. And so over this period of time, when the Maine presidency, by the way, was probably one of the most left-wing presidents we've ever had, and that's Biden. Biden was a left-winger of the highest order, and the Fed. So you have the Fed and Biden. What did they do? What did they accomplish? They accomplished the largest dispersion, or shall we say manufacturing of income inequality that's ever existed in the United States. There's been nothing like this. I mean, can you imagine the billionaires in the United States, their wealth now is equal to 21.1% of annual GDP. It was only 14.1% in 2020.
Yeah, and I think Richard Cantillon is probably smiling from above. The Cantillon effect, that screams to me where the people closest to the money supply, the people who have assets, benefit disproportionately. But you're right, and that is startling, especially at a time when everyone was locked down. And I know that one of your takes or one of your specialties is understanding inflation, and we'll talk a little bit more about that. So let me just spin it this way and say,
well, let me just make it. You mentioned Cantillon, is the French pronounce it. He actually was an Irish expat that went to France and was probably the founder of modern economics. He was a little before Adam Smith. Most people say Adam Smith and the Wealth of Nations, but actually Cantillon was probably the first. Now, he also was a great financier and operator and an advisor to John Law in France. And law, of course, created. Remember the Mississippi Company, one of the greatest speculative jobs in the history of man. And what Cantillon did, he rode that market up, but knew that it was a bubble, and that it would pop, and then he shorted things. So he went all the way up on the long side and all the way down on the short side with the Mississippi Company, and and in any case, you're right. The Cantillon effect was,
That sounds like some of the bankers from Goldman Sachs who shorted the subprime market, created it and then shorted it. There's information, those closest to it certainly benefits.
oh, there's no question about it. So the old line, there's to win a war, you need good and early intelligence.
Yeah, well, that's there's no question about that. Ask John Paulson about that. So let's imagine that you wake up tomorrow morning, Steve, and as the chair of the Federal Reserve, what's the very first action you take in this current environment?
The current environment, let's take the immediate action. We won't get into reshuffling the staff and getting some people to understand the quantity theory of money on the research staff. That would be a kind of a long-term fix. But the short-term fix, if you were chairman and were in a position to convince the other governors to vote with you, I would accelerate the growth in the money supply right now. What happened, we've been on a roller coaster ride. First, they goose the thing, and then we have inflation, and they try to stop inflation. So they've really put things in reverse. And the money supply now, the stock of money, Andy, is a little bit lower today than it was in the summer of 2022. So that kind of contraction we've only experienced 4 times in the United States since 1913, since the Fed was founded, and each one of those resulted in a recession, or in one of the cases, 2933. Actually, we had the Great Depression. That was a big contraction in the money supply. And the money supply went down about 38% in the Great Depression. That's what caused the Great Depression. It was a totally monetary thing, and anyone knowing anything about the quantity theory of money would have predicted and anticipated exactly what happened. So we right now, the money supply is growing at 3.9% per year. And since we started talking about the M's, it's M2. M2 is growing at an anemic rate. And I say anemic because Hanke's golden growth rate, a rate of increase in the money supply that's consistent with hitting the Fed's inflation target of 2%, is about 6%. So not only the stock of money has been depressed and contracted since 2020, since 2022, but the rate of growth is anemic and slow. So I would want to pick up the growth rate in the money supply, and the quickest way to do that is to stop quantitative tightening. People forget they're still in a quantitative tightening mode. So I would do that, and just as a symbolic thing, I would indicate that the Fed funds rate would probably be coming down sooner rather than later.
Doesn't that then reignite the inflation engine, take that genie out of the bottle that they've been trying so hard to fight by lowering rates and increasing the money supply?
Not really. The inflation is coming down, and remember, inflation with lags. You change the money supply, and there's usually a 12 to 24 month lag before the inflation starts reacting to whatever has been going on with the money supply. So I think that right now we've got 2.8% as a headline CPI number. That probably will come down to 2% or a little below 2% this year. Right now, and all of this, you have to realize with these lags, I can say it's baked in the cake. We know what's going to happen because of what happened 12 months ago and 24 months ago in the money supply.
what would you say to John Williams, who would say that the inflation numbers that come out of the CPI are about 8% lower than his numbers would indicate? Those numbers that when you worked for the Reagan administration as an advisor, his numbers would have said, using those numbers that were above 10%, using his numbers, because it was after 1980, I guess, or after the Reagan administration, if I'm not mistaken, that those numbers were changed. Do you not agree with John Williams of shadowstats.com?
If you use the old definition, yeah, you run the numbers and you get a different number. But it's I think I refrain from kind of getting in this debate about what's the true measure for CPI and so forth. All these measures are very fuzzy, and as a result of this fuzziness in economic measurements, you remembered when you introduced me, you said I was a charter member of the Society for Economic Measurement. And there's just a lot of fuzziness that's involved, and many definitions. There are many definitions that exist today of inflation in the United States, even official. So all kinds of numbers, and as a result, everybody on Wall Street, they have no theory of anything. They're all data dependent. Now, what's that mean? That means they just look at whatever the data are that are coming out today, and most of it is just noise. So you got lots of noise. It's coming out every single day, making some of it makes the market move, some of it doesn't make the market move. But the thing is, you've got all these people on Wall Street that have no theory of national income determination. They don't even know what the quantity theory of money is. They don't look at the money supply. If they looked at the money supply, they would realize that the data they're looking at today, fuzzy or not fuzzy, is all the result of something that happened to the money supply a year ago or 2 years ago or 3 years ago. That's what we've got. I mean, that's the daily drumbeat with the data dependency, but it's a real problem. And you mentioned my library.
Maybe that's why it seems they always miss the mark.
They always miss the mark, and the reason I'm right now holding this book by Oscar Morgenstern. This is the Bible. It's called On the Accuracy of Economic Observations. It's all in Morgenstern. Remember Morgenstern, a great Austrian economist who ended up being an expat in the United States and resided at Princeton with von Neumann. Morgenstern and von Neumann. That's where game theory came from. So Morgenstern was a heavyweight, and he's written a whole book telling you about why all these measurements and so forth are extremely fuzzy. We're not into physics here. We're dealing with economics. We're not even into engineering.
No, I agree, and it seems it would serve these people well to learn a little bit of theory, the theory you're speaking of. Maybe give them a little bit more of an accurate projection, or maybe able to hit their mark, because I don't ever remember them doing so. It seems that everything they say, whether it be about Bernanke saying the subprime crisis is contained, or inflation, there is no inflation, or it's transitory. Well, here it is. Or everything they're doing, in this case, tightening when they should not be, in your opinion. It seems they're always a little bit behind the eight ball. Let's shift gears just a little bit. I know you're an advocate of gold in terms of its ability to retain purchasing power as an asset. And some interesting things are happening right now, Steve. I don't know if you've seen them, especially what we just saw here over the weekend. But over the last few weeks and since November, the United States has become a net importer of gold, a phenomena I don't remember. We've seen significant inflows into the COMEX, while large amounts of both gold and silver are leaving the LBMA. The LBMA, which is a T+1 settlement, is now T+8 weeks. That's a problem. That, to me, signals much more than just a issue of manpower and lack of trucks that the Bank of England is citing. I don't believe that. But over the weekend, we saw COMEX delist LBMA metals futures, which was something rather provocative, rather. Do you think that this shift of metal flowing into the COMEX, leaving the LBMA, along with these massive LBMA delivery challenges and COMEX apparent distancing themselves from this problem, do you think this signals perhaps a potential return to physical gold playing a greater role in the price setting over the paper contract environment that we've been mired in for my entire 35-year career and longer? In other words, is physical going to be what sets the price instead of the tail wagging the dog with the paper market? Could this be the beginning of that, in your opinion?
Well, the first thing before I answer, let me tell you, I haven't studied this in detail. I'm aware of it, but I haven't given it serious thought. But my knee-jerk reaction is it will be difficult to do for that physical replacement. That's my knee-jerk. But as I say, I haven't studied it, and so that's.
No, with some of your pedigree, to me, the knee-jerk first reaction to me holds a lot of water, as a matter of fact, because it's not like you're just knee-jerking from a position of someone who shouldn't be knee-jerking or shouldn't even have an opinion. You certainly do, and I do. I think that we are witnessing the beginning of physical metal starting to take priority over the paper market. Certainly, watching the LBMA futures contracts being delisted from COMEX is something that I think is a shock to a lot of people. But we've been talking a little bit about this last couple of weeks and the strain on the LBMA, and it appears to be somewhat American-centric, all the metal coming in. So it certainly would be nice for all of us gold bugs who have suffered for so long waiting for the price movement to reflect reality.
So let me pose a question to you as the expert, really. That what's the basis for your judgment that the physicals will start playing a primary role in terms of price discovery?
Because when you take a look at the amount of, as an example, and this is going to be close. In fact, I might have the actual numbers. Let me see if I do real quick. I think I might. Let's see here. So here's one reason. We'll talk about the LBMA. As of last month, the LBMA claimed to have 279 million ounces of gold on paper. That's what they said. But of that 279 million, only 36 million ounces were actually available. In other words, the other 240 plus belong to the ETFs and perhaps the Bank of England. Now, so they have 36 million ounce float standing against 380 million ounces in outstanding spot contracts. That's 90% short on their ability to deliver. And we're seeing massive deliveries come out of London, so much so that we've never seen anything like it, not only by the BRICS nations, but now by the United States. And in silver, it's even worse. They have 290 million ounces of silver as the float. And they say they have just under 800 million, of which 500 they claim belong to the ETFs. And so you have 290 million ounce float, yet they claim to trade 2.9 billion with a B ounces per day, 3.5 times the annual global mine supply. Again, 90+% paper. And what seems to be very different now is they are being challenged to deliver. And they started delivering under the guise of Trump tariffs. And I think they've realized, well, this is existential threat. This is a lot different than Trump tariffs. Something bigger is going on. And they put on the brakes and say, yeah, we are a T+1 market, but now it's going to be at least 8 weeks because we have a shortage of trucks and manpower, which is just nonsense. And so I think, any manipulation, even the London gold pool, you can only manipulate a market over an extended period of time, at least my opinion would be, by pushing in the direction that it is going. And due to the lack of trust in the system, in particular the Western system, I think it's become an issue of I'd rather take the metal than the paper. Thank you very much. And that's really where it stems from.
Okay, so I, you've given us the data, which are critical to the whole thing, and you've also mentioned that's the objective thing. You've given us the objective data, Andy, and you've also given us a key subjective factor. You said trust. With any kind of financial system, you have to have a credible commitment. You have to if you don't have a credible commitment, you have a hell of a lot of uncertainty and price distortions going on. So I let me add you've more or less convinced me that my knee-jerk reaction that I gave you was probably faulty. Okay. And I'm kind of on your side. And I think a big factor underlying the whole thing is sanctions. It isn't tariffs. We've weaponized the international financial system and remember, tariffs are just a tiny part of sanctions. Sanctions, quotas, non-tariff barrier, all of that stuff comes. It's the same family of interventions, and sanctions are used by especially the Europeans and the United States just in a casual way almost every day. I mean, you get Trump; he's threatening tariffs. But what was going on before? You had Biden every other day wanting to put more sanctions on Russia or China or someplace else. So the sanctions are just pervasive now. And I think that is the trust factor. People they don't want this stuff on a ledger. They want it in the vault with them. They don't even want it in a foreign jurisdiction.
Well, I'm glad that you say that, because just a simple Google search will tell you that over the last year and a half, Germany, Austria, Slovakia, Argentina, the Netherlands, Saudi Arabia, Hungary, Belgium, Egypt, Senegal, Romania, Nigeria, Poland, Ghana, India, Turkey, France, Serbia, Venezuela, Algeria, Cameroon, South Africa, Czechoslovakia, and other countries have all brought their gold home from the New York Federal Reserve and the Bank of England. The Bank of England would give direct access to the LBMA and, of course, the New York Fed to COMEX, supporting your exact statement that you're right. I agree. This is a confidence issue, a lack of confidence, a lack of trust, and rightfully so, which really dovetails nicely into this question I want to ask you, and that's the U.S. dollar, the strength of it is often, it is, to your point, and it is, especially because there's nothing backing it, tied to confidence in the U.S. Treasury market. And that's where we saw a good deal of the sanctioning, taking $5 billion in treasuries from Russia, defaulting on them in essence, and using it to provide military support for the Ukraine. Countries look at us invading Iraq under false pretenses, still there 21 years later, after destroying their country and doing all these horrible things to the infrastructure, toppling their regime. And we're still there. And we're sanctioning some of their banks for trading with Iranian banks to buy liquid natural gas. And we went there under false pretenses. So it shouldn't be for us to determine who can and can't. We shouldn't be judge, jury, and executioner. That's, I think, the way a lot of these countries are looking at it, saying, well, if they'll do it to them, they'll do it to us. I did an interview with Judy Shelton recently, smart lady, and she advocates for, to that point, that who trusts us anymore? Who wants our treasuries that have been sanctioned, have inflation risk, default risk, all of these things. And she advocates in that case for backing 50-year treasuries and redeeming them in gold, 50-year treasuries, redeemable in gold. And she went as far as to tell me that through her discussions with Trump, and of course she was his nominee for the Federal Reserve chair in 16, some even think she may take it when Powell's tenure is up, but that he will issue them July 4th, 2026. That's what she said to me on the interview, that's the 250th year anniversary. 50-year treasuries, collared by and redeemable in gold. So with all of that and the decline in the trust in the U.S. financial system, with all of that in place, do you think that all of this that we're seeing, the reshoring of gold, becoming a net importer, comments that Judy made, the lack of trust in the system, does this support the case that Judy is talking about for reintroducing gold as a formal monetary asset backing U.S. treasuries?
Well, let me make a couple of comments just to be clear. Judy and I are good friends. Known Judy for years. we're both senior fellows, by the way, at the Independent Institute. You mentioned I was a senior fellow at the Independent Institute. Well, Judy is too. And her last book that you were probably interviewing her about, if you look at the acknowledgments, the dust jacket cover, you'll see my name on that thing. Yeah, that's the one. So I endorse that book, and I do think that you are articulating or summarizing something that is probably going to end up on President Trump's desk during his 4-year term. I would not be surprised if the issue of gold backing for a 50-year doesn't end up on his desk. I'd be quite surprised. I don't know which way he would go with it, but that's where we're going. This thing is coming. It will come off the back burner and go on the front burner, the stove.
I think I know the answer to this question. I'm going to pivot again back to inflation. As I said, we talk about it, and I think I know what you're going to say, but in this interview and in my researching your previous work, you've always seemed to emphasize that inflation is almost always, largely anyway, a monetary phenomenon, an increase in the money supply. And the rising prices are a symptom of an increase in the money supply. And this is driven by